Good morning, ladies and gentlemen. Here is again the Boring Lectures channel, and indeed, perhaps not boring today. General Introduction to Tax Law, Chapter 4 begins. How do we determine the income? You have heard in the last chapter that there are, at least in German law, 7 different types of income. Other countries have similar approaches. And when we go a bit more into details into what we find in German tax law about determination of the income, then you have the fundamental question, revenue minus expense or profit. Yeah, and that reminds me and you of what we did in the last chapter. The income is defined differently according to the type of income. In the income types number 1 to 3, you always calculate the current regular income, so revenues flowing from trade, for example, or expenses related to trade, plus the gains from selling property. Types number 4 to 7 are the surplus types of income, and their only current revenue minus current expense count. Several exceptions, of which you already came across some. For example, sale of a private house within 10 years after acquisition, if you didn't use it for own housing purposes but rented it to others. Basically, that's the point. And now also the income was defined differently, because in the profit types of income, the first 3 types, then you have to determine the profit, that was current income plus income from sales, and in numbers 4 to 7, the surplus types, you had to calculate the surplus of revenue over income related expense. And when you look for the legal sources, you can find that in paragraph 2, section 2, number 1, or respectively number 2 of the ESDG. So nice references to polish up your case solutions if you want to make a case solution. And you will have to one whenever you deal with taxation. Without being able to solve cases and having practice in that, the whole thing doesn't pay. Well, the technical terms, you remember that were when we speak of business income types, then we have business revenue, in German Betriebseinnahmen, or business expenses, in German Betriebsausgaben, and the result is the profit. And the definitions for these terms are to be found in paragraph 4 of the German Income Tax Act, the ESDG, the Einkommensteuergesetz. And the other ones are defined as the difference between revenue and income-related expense, defined in paragraphs 8 and 9. By the way, perhaps the one or other among you wonders why I always use the abbreviation ESDG, although it's an English, not an English abbreviation, but a German one. Well, one might naturally always translate Einkommensteuergesetz as Income Tax Act, then everybody understands it. Great. Now, when you use ETA, Income Tax Act, as your abbreviation, that would have a big disadvantage. The disadvantage would be it's your own personal abbreviation. Only those people recognize that abbreviation who know about your translation for Einkommensteuergesetz, Income Tax Act. And now others might translate differently, and others might use different abbreviations. So when later you write an English text and that text goes then to a German reader sees something about paragraph 2, ITA, and thinks, okay, what does my English colleague mean with that? Probably Income Tax Act. Now somebody else calls it perhaps the Business Tax Act, or what else, I don't know, perhaps a wrong translation, but then somebody else shows up with, again, a different abbreviation. And so in the end, there's probably chaos. Is the abbreviation my colleague from Australia uses the same as my colleague from Düsseldorf or my colleague from England uses? And so it seems to me the best when it comes to abbreviations, usually you just have to learn them by heart. So I would always recommend to use the local abbreviation, here ESDG for Einkommensteuergesetz, because then everybody, German reader, directly sees, as this is the official abbreviation in Germany, directly recognizes of which law you are writing or talking. Naturally, when you then explain that to others, you would say Income Tax Act, but when you abbreviate in written form, the best thing is use the commonly and widespread abbreviation, which everybody knows from the country that you're talking about, because that's the most easiest way to get understood, even across the language border. If you speak with a German, ESDG is always recognized by somebody here in the inland. Everybody directly knows where you're speaking about. And additional advantage, when you later read a German text, you directly recognize the abbreviation and you don't need to translate it. It's not a surprise when you later read something in German text. So that is, under my perspective, or from my view, the great advantage of using local abbreviations. It's not a great help to translate an abbreviation and replace it ITA or so, but it can cause a big amount of confusion. Okay, not back to the future, but back to the slides. Here we have the terminology, you remember that. And I mentioned in the overview about the business income types and the private income types that there are some exceptions where also the sale of private property might be taxed. There are mainly 3 exceptions. The overview is here. When you sell capital investments, even if they are private, since 2009, every gain from private capital is taxable. That's in section 20, or paragraph 20, section 2, ESDG. You remember that was a special rate of 25%. Gains from private property are taxed under section 22 number, and now there's a mistake on the slide, number 2 ESDG, in combination with an explanation what it means. In paragraph 23.1 ESDG, immovable property is taxable if sold within 10 years after acquisition. The exception is if that house has been used for your own living purposes during the last 2 years before the sale, or if you inhabited that house ever since you bought it, or for other private property apart from everyday household things. They can be taxable within 1 year or, under certain exceptional circumstances, within 10 years after acquisition. That depends on the kind of asset involved. And the third exception is gains from a major participation in a capital company. Major participation in that sense, the threshold has always been lowered down. Originally, 30 years ago, it was 25%, then it was lowered to 10%, and later the threshold was lowered to 1%. That is covered by section 17 ESDG, and it's classified as fictional income from trade. Now that peculiar exception has basically become senseless since the introduction of 22 ESDG, every capital investment. That also means shares is taxable when sold. But section 17 follows some different rules in the calculation of the gain. For example, the 25% tax rate does not apply, and that is the rule why this additional, the reason why this additional rule has been kept ever since. So when it comes to selling shares, it is still a difference. If you own more than 1% of the shares issued by a capital company, then that would be treated in German law under paragraph 17 ESDG, and if it's only a single share or 3 or 4 shares in a big company, then it would be section 22 2, income from capital, taxed with the flat rate. Okay, good. And now naturally it is time to talk about cases. We have up to now not solved cases together, and the basics of all tax knowledge is practicing cases, cases, cases. There are jurisdictions where people say blood must flow. When it comes to taxation and learning taxation, the sentence is a bit different. Ink must flow, ladies and gentlemen. You must write case solutions, and case solutions. So here is a simple one. Mrs. B lives at Kleve, but also has a few rooms in the house of her parents, far away in Faroestan. And so she has 2 homes. She has a job as an employee in Kleve, receives, well, here you see that's a minority view on orthography. So it's simply spelled wrongly. Receives a monthly salary of 1,000 euro, has taken up that job on March the 1st, and she always gets her remuneration on the last day of the month. She has travel costs to go to the job of 1,500 euro, and now in many jurisdictions, also in Germany, there are some specific rules how to calculate the deductible amount of travel costs to the job. So I add this amount of 1,500 has already been calculated correctly under German law, because it would be rather specific to start with calculating such a specific thing. She also owns a house which she got inherited from her mother in Faroestan, and the monthly income from rent amounted to 2,000 euro there. Repairs were made in December 2000, but they were paid in February of next year only. The facade was painted newly in June, and according to neighbors, that was a complete waste of money because nobody needed that. The facade was perhaps good for still 2 or 3 further years. The costs were 5,000, and she paid it in August. And furthermore, she has written a book. The publishing, again, that shows she should rather not write a book because publishing is also typed wrongly. Sorry, it was a bad day when I conceived that case construction here. The publishing house paid her license fees for the book for this year of 10,000 euro. Paid to her naturally, isn't it? In order to have enough ideas for books, she always buys every crime story which she can get hold of. The costs for these books were last year 9,000 euro. She also has a rent income from a house in Russia, which is because Germany has a double taxation treaty, a DTT with Russia. This house is tax-free in Germany because it is taxed in Russia only 45,000 euro, and she has special expenses and extraordinary expenses amounting to 2,000 euro, which is rather a small amount. Okay, let's think how we should deal with that, ladies and gentlemen. Now, this is the case again, presented in a small fashion. Our solution now, let's start first. Personal tax liability. That's a clear thing. Relatively simple. Sorry, that's PowerPoint. Not always the best. Oh. What's going on here now? Our solution. Sorry, something I made wrong. She's a natural person. So ESTG applies. Subject was subjected to unlimited tax liability 1 ESTG because lives at Kleve, so she's resident there. So the residence there. See section 8 AO. That she also has an additional residence in the country of her parents, does not change anything to that, because naturally one residence in the inland is sufficient. Analysis of the events, ladies and gentlemen. Event number A, job at first question, which type of income might it be? Well, it's income from dependent work. That's paragraph 19, number 1, ESDG. So far, so good. So, part of the worldwide income under section 2, 1, and the number is number 4 because this is the fourth type of income. Tax base is the surplus of revenue over expense. See, I'm evidently really nervous today because I'm always making typing mistakes. That's awkward. Might become better in the course of time. 2. Hey, come. 2. Number 2, ESDG. And now we are going and look for revenue and expense. So here revenue is 1,000 per month. 12,000. That's revenue because it's money. And all belonging to this year because always paid during the month, so all money was received during this year, so taxable this year. C 11.1 sentence 1 ESTG. I hope it is. Now I made a mistake and let's change that for 10 months only, March to December, so it's only 10,000 euro, which she received from the job. Here you directly see which mistakes from carelessness you can travel cost. The travel costs is income related expense. Let's express it this way because that's more precise. Under 9.1 sentence 1 ESG, because incurred, so made in order to secure the job. Without traveling to the job and backwards, you can't keep the job. So deductible expense. Deductible expense is nothing else than a synonym for income related expense. Yeah. Correctly calculated under German law, that means nothing else than there are some special rules, but we don't need to take them into account here in a big way because she owns a house. So that's evidently number B. Inherited from her mother in Far-Western, and the monthly income from rent is 2,000. Repairs were made, but they were paid in February next year only, and the facade was newly painted in June, according major neighbors, a complete wait of time. Okay, and of money. Let's go to the house in Far-Western. Now, the worldwide income is covered by unlimited tax liability, so the house is relevant for our case. And so that's, oh my god, wrong line. Income from lease and rent That section 21.1 number 1 says this because it's letting of immovable property to tenants. And next idea. So part of the worldwide income under paragraph 2.1 number 6 ESDG tax base is not the profit but the surplus of revenue over income related expense to number 2 ESDG again. And now let's look for revenue. Revenue is 12 times 2,000, 24,000 is revenue because it is money. So that's it. And now let's go on a bit. Let's create some free space just by a trick. Let's decrease the letters a bit. So that was all received in this year, evidently. In this year 11.1 ESG. Now let's go on. We have now repairs made. This is in principle income related expense. Because repairs were made in order to sustain the income from adding the house to tenants. That's relatively clear. Broken windows, no tenants in the long run. But deductible only next year because paid only next year, so belongs to tax base of next year. See section 11 to sentence 1. SDG. Look it up, ladies. Then painting the facade. Now, if I paint a facade which is of a house which is entirely used for tenants, this probably has no private motivation, so it's income related expense, because for my private consume this has no importance at all. Income related expense. Sentence 1 again, because made in order to, in the long run, secure the income from the tenants. Now, ladies and gentlemen, again I need some free space. So let's reduce again a bit the space here, and that the repairs are not necessary has no importance at all. It is sufficient that they are caused by the income motive. Yeah. So 5,000 is deductible Okay, let's move. That's deductible expense. Okay, so deductible this year cost paid in August. August, please. Hey, 11/2 ESDG. Well, to sum up, oh no, 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 no. Let's come back here. Add one. To sum up, so we have income from event number B. This is 24,000 minus, well, 2,000 only belong to next year, so 5,000 paid in August, 19 euro. By the way, we should also add total for the job at Kleve. I make that visible again for you. Total for job at Kleve. 10,000 minus 1,500, that's 8,500. At least I hope so. Good. And that's it. Now let's go on. Part 2 of our nice little master solution. She has written a book. That's number C. The book. Well, writing a book and publishing that gives you license fees. If you don't print it yourself, that's income from self-employment. It's a free profession. Section 18(1), number 1 ESDG, you can find that writing is a free profession. So that's a part of the worldwide income under the rules of 2(1), number 3 ESDG. The tax base is not the surplus, but the profit. And here's again a small mistake. It's not 2(1), number 1. 2(2), number 1. Yeah? Good. And the profit is business revenue minus business expenses. If she has no balance sheet to make, profit is usually to be determined by balance sheet. We are going to hear that later. Paragraph 4(1) is no ESDG. But in her case, it can be determined by simplified calculation. Business revenue minus business expenses, and here that's 10,000 revenue received this year, so taxable this year, 11(1). Deductible business expenses. Now let's check 9,000 euro for crime story books. Cost by business, section 4(4) ESDG, is possible. But now because she reads it, she reads them to get ideas. But collecting crime stories also has a private consume aspect. So mixed expense, mixed causes for the expense, and so that renders the whole thing non-deductible, deductible under paragraph 12(1). Here, no, 12 has no ones. 12 ESTG. Yeah. Because may it be necessary or not, the decisive aspect is not necessity or not necessity. The decisive aspect is if something is caused by business, and if it's caused by business only, and that is not really guaranteed here. D. Rent income from house in Russia. First question, is it a type of income? Yes, it's income from lease and rent. Lease and rent. Again, under 21, number 1 ESTG. Amount given as 45,000, but tax-free under a special rule in the DTT, Double Taxation Treaty, but relevant for the determination of the tax rate under the proviso for proviso safeguarding progression. My God. Huh? Now that gives you really the superiority feeling that my typing is really bad. So, taxable 0, relevant for progression calculation, plus 45,000. And now we have special expenses. So how can we get along with all these things? Let's think about the final calculation. So to sum everything up, we have first job income. That was 8,500, see above. Second, we have the income from house in Faroestan, and there is nothing mentioned that that house could be tax-free also under a double taxation treaty. So we have just to regard this as part of the regularly taxable income, and that was 19,000, just to look it up, 19,000. Then the book, income from lease and rent, again from the, no, income from, you see I'm unconcentrated, not from lease and rent, from self-employment. That was 10,000 because the 9,000 were not deductible. Good. Total income, or better, total taxable income, total from the types of income, you can call it as you want to, 30,500, minus special expenses, special personal allowances, and extraordinary expenses, given as minus 2,000, given actually, given. So we end up with total taxable income, or final total taxable income. In German zu versteuerndes Einkommen, 35,500. Relevant for the progression calculation or calculation of the tax rate is what? Taxable income, 35,500, plus tax-free income, which is subject to progression calculation plus 45,000. So we end up with 80,500. Good. 80,500. Now tax for 80,500 would be, and now we have to use the tax rate for a certain rate for a certain year, so the tax tariff. And now please excuse me, I have to take the tariff for a certain determined year, and it changes every year a bit, and so I take 2020. Please don't kill me if next year I don't update that. So you would then just adjust that to with the figures for the current year if you later in future years deal with that case. So that would be 40% on everything which you earned minus a deduction which compensates the fact, that the first slices or brackets of your income are cheaper, and that ends up with this formula. This is 33,810 minus 896374. That's the correcting factor for the fact that not everything costs this. And let's calculate that. 8963.74. This is 24,846.26. That corresponds to a percentage of, and now let's calculate 24,846 divided by 8,500. 30%, 86491. You can round it a bit or less, more or less, it doesn't really play a role. And that rate applied to the taxable income of 35,500 leads to a tax of 35,500 times 38,6491%, and that ends up with 10,957, sorry, German comma, and 4 cents. Okay, taxes are always rounded down to even euros in Germany, so that would be this final solution. And end of case. Thank you very much, ladies and gentlemen. So, ladies and gentlemen, now let's create some distraction, confusion, or let's just make the case a bit more complicated, fresh it up a bit, and let's have a look on a small variant of our case. Let's, for example, imagine that Mrs. B wants to lower her income because she has heard from us that her tax will be relatively high, and now she wants to lower her income so that her tax goes down. Now, for this reason, she has, as she thinks, an excellent idea. She buys a house at Kleve for 200,000 euro on the 1st of December of the year 01. That is, as always in my charts and cases, not the abbreviation for the year 2001. This is just the abbreviation for year 1 in the history of our case. And in all the years 01, 02, 03 or so, we have always enforced the law of today so that we never have any transition problems between old laws and new laws, because it makes no sense for you and me as beginners to learn old law. Well, let's turn back to the case. So on the 1st of October 01, she buys a house. Now she has the nice idea that she wants to deduct the cost of the house. So evidently that will have to be checked now. So renting a house to tenants. First, let's think about the type of income, as I always recommend it to you. That's income from lease and rent under German law, section or paragraph 21, number 1 ESDG, because it's immovable property. So it would be part of the worldwide income under 2.1 number 6 ESDG. That's absolutely right. The tax base would be the surplus of revenue over income related expense. That's paragraph 2.2 number 2 ESDG, where you can get that definition from. And now let's look for revenue. That's evidently the December rent here, 2000. Receive, it's income because it's money. Received in 01 still, so taxable in the year 01. See section 11, 1 sentence 1 ESDG. And now let's think about expense. And now here's the trick. The term expense stands for some decrease of property, so getting poorer. Here, buying a house is not becoming poorer because one just exchanges property with a value of 200,000 cash against another property item, asset of with value of 200,000, the house. So no decrease of property. Purchase is no expense. The price of 200,000 cannot be deducted. But what can be deducted is the loss of value of the house over time. I don't know, don't remember if you already know from bookkeeping lectures or others that naturally there is a situation that at the beginning, when you buy the house has a full value of 200,000. Now imagine, go to the future 50 years more, perhaps then you have a house which is a complete ruin, so the value then will be 0, and so the value must have gone down over time. In the meantime, 200,000 at the beginning, 0 at the end of the house's useful life. So you know that you have become poorer over time, but you can never exactly say when. And this is the fact with all so-called fixed assets, the things which you buy and use for your enterprise purposes, or which you use for producing income over time. They are subject to wear and tear, and so they lose their value, but they lose it constantly. And so the deduction of the complete price at the beginning would be wrong. The deduction of the complete amount only at the end would be wrong because it has already lost nearly all its value shortly before. And so the most adequate solution is distributing the loss of value equally over time according to some methodical approach or idea. So that is called the depreciation amount or the depreciation, and that is explicitly allowed in paragraph 9.1. I don't remember the exact number now, so, and as I'm lazy, Christmas is going to come, so I'm lazy. Look it up. So in the ESDG, there you also find you can deduct the depreciation for a house. The basic idea is price divided by years of useful life, but special rule for houses is in German law because it's difficult to prognosticate the exact future life of a house, so German law just wants to avoid disputes and just says, let's take 2% per year. That's here, 4,000 per year. But let's reduce, let's take some more space. Yep. Easy. But here the house was not used already for a full year, but only for 1 month. So the depreciation is only granted for the respective time. That means, as one says, pro rata temporis, so Latin expression for the part of the time. So here 1/12 of 4,000, and that, ladies and gentlemen, what is now 1/12 of 4,000? How did I ever come to that idea? Well, 1/4 is 4,000, and 1/3 of that makes it then into 1/12. That is 300. You see. So we end up with an income of, so result, Mrs. B can not lower her income by this transaction, because might be nice to add that final sentence, because evidently that was the motivation behind the whole maneuver, and that is why I added that. By the way, if, for example, she needed to take a credit to finance the acquisition of the house, then you would have had interest expenses and perhaps other additional expenses. Then it might have been that the income in the beginning might have been negative, but as the matter stands here, the income is not negative. So if she only wants to do it to get rid of her taxes, wrong approach this year. Thank you for listening to this, and let's go back to our slides. Yeah, and here is again directly the next small question. A case again, but a very small one. Business owner BO, let's assume he is living at Kleve naturally, constructs a factory building, does much himself. So buys raw material, but working is done by himself, and wants to deduct the value of his working hours as expense. Yeah, so naturally you don't erect a factory building entirely on your own, but evidently he also worked together with other workers, and now he wants to deduct the value of his own working hours as expense. The minimum wage in Germany per hour is approximately 12 euros, so he wants to value the work which he contributed with 12 euro per hour he worked. The question is plain and simple, is that possible? So, constructing a factory building is first not getting poorer. So the first thing would be, if we have calculated the cost of the factory building, you would have just an exchange between the cash which you paid for the building and, let's say, 200,000 cash for the building, and a building with a value of 200,000 which you got in return. So you don't become poorer at the first moment, only over time by depreciations. So the only reasonable question would be if we can regard the value of his working hours as costs, which we can regard as a part of the price which he paid for that building. For example, if he contributed 1,000 working hours, can he then add 12,000 euro as additional amount paid by him for that building? And the answer is a simple no. Costs and also expense, that means things by which you become poorer. Now, your own working time, spending that does not make you poorer. You just renounce on money coming in. But you get your own personal working time for free. That costs you nothing. You don't pay for it. So spending your time on something doesn't make you poorer. Yeah, and now let's look what we can say about the fate of this case. Personal tax liability is naturally the first step again, and Mr. Newman is a natural person, so ESTG applies, and he is subject or subjected, however you call it, to unlimited tax liability in Germany because he lives in the Inland Sea, paragraph 1.1 ESTG. So then let's analyze the events, or the so-called objective tax liability. Event number 1, writing the book. Harry Potter Part 12. He gets license fees, 30,000, but let's begin with the income type qualification because that's always the best idea. It's income from self-employment, paragraph 18.1, number 1. You remember self-employment were under the specific German usage of the term only relatively noble intellectual or high-standing professions, those which were in the medieval times exempt from the city trade tax. So not every self-employed person who runs a business, but only very, very special businesses. Okay, but nevertheless, it's part of the worldwide income, paragraph 2.1, number 3, ESTG. The tax base for that part of the income is the profit. And the profit is here to be calculated as the revenue from business minus the business expenses. And so 30,000 is given as our business revenue because it's caused by Mr. Newman's Harry Potter book, so by the business activity. And we can offset against this business expenses. That brings up the question if the lawyer's costs are business expenses. A business expense is expense what is called by business. Does paying a lawyer make us poorer? Yes, the money is gone. And is it caused by the business activities? Yes, without writing the book, we would have no lawsuit to stand. So the answer is yes. any private consume aspect is not contained in the whole matter. So the thing is deductible business expense. Yeah. So the 5,000 are deductible. So we end up for event number 1 with an income from the event of 25,000. Let's continue. Event number 2 is a house in Germany. Letting the house to tenants. Let's determine the type of income first again. So that's income from lease and rent. 21.1 number 1 ESDG. That makes it a part of the worldwide income according to the list in section 2.1 number 6. Tax base here is the surplus of revenue over expense, section 2.2 number 2. And the revenue is given as 3,000 euro rent income. That's revenue because every money is revenue if it's caused by one of the types of income. Is it income related expense, which we have there? Nothing it mentioned, but remember the house loses value over time, so the depreciation for the house must naturally be looked for. 2% can be set off according to, now I tell you where you can look it up in the ESDG 7.4 number 2. 2% of 200,000, 4,000 per year, but again, naturally, this is only granted pro rata temporis, so only for 6 out of 12 months, so half of the annual depreciation is 2,000 euro deductible, so it's indeed deductible, and now this time I have looked it up, 9.1 number 7 ESDG. So the income from event number 2 is 3,000 minus 2,000 is, I believe, according to conservative calculation techniques, 1,000. Let's finish that event and go to the next one. Mr. Newman owned a factory. So think about the factory. Factory is having a business. So it's business income. Section 15.2 says what a business is and who has to pay for it or whose income it is regulated in 15.1 because there is a sole trader, there's a partnership, there are others. So 15.1 number 1 says a sole trader is fully liable or is fully responsible or gets fully attributed the income from his sole proprietorship naturally. Well, just a nice reference for the self-evident and for the common sense solution. Now you can again get half of a point or a quarter of a point for the usual statement that if something is a part of the 7 types of income, that is automatically a part of the worldwide income of that person under 2.1 number 2. It's now in the list business income. Tax base is for business income the profit. That is something you can look up in 2.2. Here, number 1. The current profit is given in the task, so no question, no task where you would have to calculate or assess some facts. But the factory, building, and the piece of land will then turn from business property into private property, and this is a so-called withdrawal. That has to be treated as if, in a simplified way, as if you had sold the business property to yourself at the market value at that time when you withdraw it from business sphere to the private sphere. So let's imagine a fictitious sales price of 3 million, the market price at the moment of the withdrawal. Then, on the other hand, you would have to remove the assets from the books. So booking them out creates an expense in form of the book value, which you remove 300,000 here. So the net gain from the withdrawal is 2.7. And if you add up everything current, profit plus the income from business, that's 2.9. 200,000 plus 2.7. You see here's evidently a typing mistake. It would have been a miracle if this case would have gone without any typing mistakes. Naturally, nobody is perfect, and unfortunately no case is perfect too. The factory in Abrodia is again income for business, part of the worldwide income. So it matters always, at least for the progression. tax base is the profit, and due to a special rule in the double taxation treaty, which is given here, so not to be debated, it's tax-free. But then tax-free amounts have to be calculated or taken into account for the tax rate calculation, so we need it later. Well, to sum it all up, here are the events, and the medium column just gives you the taxable income, and the right column gives you what counts for the calculation of the tax rate. Naturally, we need to calculate the tax rate calculation first. So tax rate calculation is based on 3,096,000, and under the tariff function for the year 2020, that leads to a tax formula which is printed here, and it leads to a final amount of much money, 1,376,121.30. This now was only calculated to find out a percentage. How many percent of 3,096,000 are these? This is 44.44836. That is the percentage which is then to apply to the taxable income, the total taxable income at the end, and that leads to 1,287,224 euro, if I'm not mistaken, which I'm ashamed to admit I frequently am. So never believe me, always look it up. And naturally, one thing is clear, the tax tariff function in Germany is adjusted to inflation every year. So next year you will have to look up in the tariff, follow the simple principles which you have seen here, and redo the calculation with some current numbers. But at least for 2020, we are safe and can rely on what we have found out. Yeah, ladies and gentlemen. And by the way, why do I always call you ladies and gentlemen? You are probably not genuine ladies and probably no gentlemen, but I have no better way to address you. Sorry for always that repetition. Well, now perhaps these small cases might have impressed you, confused you, irritated you, frustrated you. I do not know. At least you will probably now be interested in the details, which you have seen there and which you want perhaps to understand now. At least I hope so. So in this area here, we will go on with debating the surplus of revenue over expense, and later call about measuring the business income. So we begin with the tax base for the last four types of income, because that's more simple to explain, and then we speak about business income, where we sometimes need a balance sheet for such things. Good. Let's repeat again the definition of surplus, which you find in 2 number, and sorry, here's now again the unavoidable typing mistake. It's number 2 ESTG here. Income is the term here for revenue minus expense, or minus, which is better as a translation, income related expense. The German words Einnahmen and Werbungskosten are relatively old-fashioned, at least in the case of Werbungskosten, but the advantage is both parts of the definition are revenue and expense are explicitly defined in sections or paragraphs, which is better from the German perspective, in paragraphs of the ESTG, namely in paragraph 8 and 9 ESTG. The definition for revenue is probably the thing which us interests at the beginning and immediately. Revenue, we can read there, is everything which consists of money or which has a value in money and which is received by the taxpayer within the scope of the types of income numbers 4 to 7. That means, first thing you need to understand is not only money is considered as revenue, but everything which has a value in money, so which you can measure in money, that's also a revenue. And naturally, revenue is only taxable if it goes back to one of the types of income. So if it's caused by one of these activities, that's clear. So that explains the second half of the definition. Now, first of all, think a bit. For example, about your home state law, about German law, about the law of other countries. Why is it economically absolutely necessary for the function of a tax law that you can't restrict yourself to taxing revenue, which is money? And the answer is, what would happen if you only tax cash or bank transfers? Then the people would turn to barter trade. I want to sell you my house, but I can't use any money. Can't you give me some cars for free in return? Well, so you would exchange things against things. If you go to the doctor refuses to take cash because that would be revenue. Doctor prefers to get some advice from you if you are a lawyer or a tax advisor for free, because that would not be revenue. An economy would immediately break down if you make such a distinction in the tax consequences between cash payments and cash equivalents, or things having a value in money. So it's absolutely compelling that everything which has a value in money, which can replace money, must be regarded as a taxable revenue too. And you will have to value that, that's no surprise, with its market value, with its monetary value. And it might be a nice task to look through your home state law or any other law which you come across and check if it's really done there in the same way that things which have value in money naturally are counted as monetary revenue under tax law. And naturally, it would also be interesting if you find some cases where that is not the case, why this is done and where it is done. Okay. Now, if you have received something which is not money but has a value in money, you have the problem that you have to calculate its monetary value, because naturally when it comes to the tax declaration you can't add up €1,000 in money plus 5 apples or 1 car for free. So you need to find the monetary value, and the general rule, the basic rule, is that you need to take the market value. Now there are several market values. Probably there is a price for goods probably paid between a wholesaler and a retailer, and the price between retailer and final customer. And the general rule is you take the final consumer price, which is usual at the price of delivery. And as you look to a market price, you are not interested in fictitious official prices, but in that what a usual consumer really pays. So if discounts are usual, then the discount has to be taken into account when you value the market value. That's relatively simple. And the reason naturally is if you make a deviation, a difference between the market value and the tax value. then it would have different consequences to get the cash and then spend the cash in acquiring that good or getting that good directly. And then you would again have distortions in the functioning of the market, and the whole affair would no longer be convincing. A general principle should be of a reasonable tax law that it should make no difference if you get 1,000 euro in cash and then buy something for it, or if you just get that thing directly with a value of 1,000. Well, otherwise, that would not be convincing. Now, sometimes there are specific or special rules for certain cases, for example, because you need to simplify the matter or reduce the potential for disputes in court. For example, if it comes to the monetary value of the private advantage from the possibility to use a business car for private purposes, then you could end up in endless calculations, dispute many of the cost positions, and probably you could keep the fiscal administration officers busy for 2 days for just checking the correct calculation of the private advantage, such a private advantage, and doing all the letters with the taxpayer and dealing with his counter arguments and all that. So very often such standardized market value finding rules for specific cases are often to be found in cases which appear in a very massive extent or where exact calculation is extremely difficult and has an extreme unjustifiable workload, so that under the aspect of the bureaucracy cost, all the other taxpayers would just say, don't waste time, it's far more economically for us, the other taxpayers, and for you, the bureaucrats, just to make an approximation. Even if it's not perfectly fair, the effect of that unfairness, little unfairness, is far overcompensated by the amount of cost which can be saved. In Germany, for example, you find such special rules then in H2 directly after the general rule. For example, there is a valuation rule for the advantage which you have from getting the permission to use a business car of your employer for private purposes too. Then very often people get meals in a cafeteria or a mensa near their workplace, and that is either fully paid or subsidized by their enterprise. And now if you get meals offered for free or for a far lower price than the market value, this is also a monetary advantage. And now you might think that's rather a low one, but if you imagine that 20 or 25 days in a month you can feed for a very small amount of money, this is, or you get your meals for free, this is over the year a considerable difference to people who don't have that advantage, and so it should not be completely ignored, but that monetary advantage should be regarded as a part of your income. Also, if your employer pays your private location, your private habitation, this is a considerable monetary advantage because you save all the costs for having an own flat or renting it from somebody else, and this is, as you all know, a considerable amount of money per month. So you should not ignore that, can't ignore it if you don't want to treat different taxpayers unfairly. Sometimes you have other simplification rules. For example, in Germany, you have a rule that small non-monetary remunerations which you get on top to your usual wage are left out of consideration if they do not exceed 44 euro per month. From 2021, that will be increased to an even 50 euro. Great advantage of social nature. So in that case, even that 50 is a simplification. Important is that you read the if. If is a condition which either is fulfilled or not. It's nothing where a compromise can be made. So 43 euro monetary additional advantage in a month, apart from certain exceptions, is left out of consideration. You can get that without having to declare that or to pay taxes on that. The idea is the bureaucracy work there is too much. But now if you get 45, or from next year onwards 51 euro or even 50 euro and 1 cent, then the idea is then you are above the threshold and the monetary advantages of that month count. And now the idea is, if we bother to fill in some tax returns and forms and do all the bureaucracy stuff, then we do it properly, because then we don't do it only for the 1 additional cent, and we do it for the whole 50 euro and 1 cent, or for the whole 45 euro. So that's the effect of an if condition. The opposite would be an as far as condition. That means the money, an amount is tax-free as far it does not exceed, let's say, 44 euro. Then the next euro would be taxable, because then the exemption is always granted from 0 to the limit, as far as the limit is, and the amount beyond the limit becomes taxable. In case of an if clause, it's always the full amount. Good. Let's concentrate a bit of some of these standardization rules. The monetary advantage which you have from the right to use a car for private usage is you can either value it at the cost of your privately driven kilometers. Then you need the data of all the kilometers which were driven in private, and you need an exact list of all the costs of that specific car. If these data are not obtainable or not correct, then the fiscal administration turns over to a standardized value which is fixed at 1% of the gross list price of the car, which was valid as at the time of the first registration with the authorities, plus an additional amount of 0.03% of that the same gross list price for the distance between private home and your working place. That's a rather strict simplification. The idea is nearly everybody, for all these typical private travels like holiday, shop, haircutter, the distances driven are nearly always the same for every family. So, but the main distance which you drive every day, that is the distance to work and back, and that is highly different for different people. That might be 100 kilometers per day for the one worker, and it might be 5 kilometers or 1 kilometer only for the other worker, and so treating them in the same way, although there is such an enormous difference, that would be regarded as incorrect, and that is the explanation for that additional factor which is added for and refers to the distance between working place and private home. The taxpayer has the right to choose if you can give the exact date cost calculation, then the monetary value will be equaling the costs of the privately driven kilometers. The idea is that is then the amount of cost which you save because your employer took them over. And if the calculation is not exact, you are confronted with that 1% rule. You have the right to choose, so you can decide, even if you have made an exact cost calculation, to throw it away and choose the 1% standardization solution, although you have to stick to your choice for a certain time. Also, the value of a meal is standardized because it would be an intolerable bureaucracy if you had to watch in your cafeteria every employee and put down notes which things that specific employee ate for free on that day. So if you offer your people a free meal, there are standard values for a meal which are then officially announced shortly before the beginning of a year. They are then officially fixed by the fiscal administration. In the year when I first made that slide here, the official breakfast value was free breakfast was 48 euro per month, and so one breakfast one day was 130, so 48, so €1.60. That's relatively cheap. And lunch or dinner was 88 euro per month. That was approximately €2.93. In the meantime, I believe it has risen to €3.30 or so. Don't know because I don't memorize it really, because it changes every year. It just goes up a bit. So if an employee has to travel for business reasons, has to stay in a hotel, and the breakfast is included in the price, hotel is paid by the employer. In that case, you got one of the meals for free because you are employed by your employer. So €1.60 has to be calculated as an additional revenue. At least that's half of the truth, or a basic aspect of the truth. Or you can get a free lunch in a Mensa of the enterprise, has to be valued €3 per day, and that is then an additional revenue which has to be deducted. By the way, some months ago in 2020, there was a court decision where there was a dispute if it is really necessary that the employee has eaten up the meal, or if it is sufficient that it was offered to him or her to form an additional financial advantage. Now you can imagine what that could have meant if you had to distinguish if you offer somebody a meal for free or if that person really took that meal. Because then you would have again to place somebody in the cafeteria or Mensa who then has to take notes who showed up and really ate up the meals. And probably in the long run, some people would have said, well, my stomach is not the best one. I can only eat every time half of my meals. I can bring witnesses for that. And so we now make a lawsuit which is going to run 10 years in order to find out if, in my case, the €1.60 or so for a meal have to be reduced to 80 cents. So we can understand that the courts ruled that according to the exact wording of the legal rule, it is sufficient to be a financial advantage for the employee if the meal was offered. So if you got the offer to take it for free, and if it's your free choice if you take it or don't take it, because the financial advantage is then already seen in the offer. You can dispose about the offer, and the other idea is otherwise every simplification effect of that standardization rule would be completely lost. Here practice goes over exactness. Sometimes you also have additional rules for simplification reasons, or sometimes even to subsidize certain behavior from employers towards employees in order to give them an incentive to do something which is socially favored. Such tax-free income is then listed in paragraph 3 ESDGs. For example, if your employer subsidizes a retirement pension fund for an employee, or in principle it would be a private advantage, so a monetary advantage if you can use your employer's telephone for a private call, or if you can use a computer for a private letter, or for surfing during your lunch break in the internet for 5 minutes using your enterprise's computer. The problem is then one would have to calculate the market value of that, and that would be, again, so much bureaucracy that it doesn't really pay off, and so it was declared tax-free in order to get rid of that problem. The same or a similar problem is also the tips for waiters in restaurants and the tips for similar professions where tips are customary. In principle, that is a monetary advantage, a revenue which these people get from their taxable activities. But on the other hand, it's absolutely impossible to check and control this, and it would be just completely unfair, because the only thing would have to be you had to rely on what the people voluntarily admit, and the honest people would pay and the dishonest would not pay, and you could never prove to the dishonest people that they are dishonest. So that would be really, really awkward. If your employer gives you clothes for the work, for example, you are a craftsman and you need special clothes to wear for the work, then that it can be given to you for free, but not if you could also use them for private purposes. You can freely refund travel costs to an employee without that it's regarded as a revenue, and other things. Yeah. Okay. A specific and very special rule really is in 8.3 ESDG, rather a nice thing. An employee sometimes can buy goods offered or sold by the employer with a discount. The idea is, I don't want to make profit from selling things to my own staff, or it rather creates a bad atmosphere if my own staff has the idea that I get rich on their purchases. It also is the idea of I want to give my people an incentive to buy in my shop and not in the shop of my competitors. It's also a kind of being nice to employees to grant them a discount, usually a relatively huge one. Now, the opportunity to buy things from your employer with a discount below the market value is naturally a monetary advantage. So it's a kind of an additional element of low wage. And that is a reason why that also is regarded as revenue. And now, some 20 or 30 years ago, might even be 40 years ago, somebody found out, well, if somebody works in a car factory, these people can buy cars with a discount, let's say of 20 or 30%. And now, every 2 years, I believe, depending on the car factory. And now imagine what that means. You can buy a car with a value of 20 or 30,000 euro with a discount of 20 or 30%. So that's an amount of between 4,000 and 9,000 euro, which you can save every 2 years. So that's an additional enormous amount of money. And so a tax inspector once found that out and said, oh, that has always been overlooked. We must tax that. This is such a considerable advantage. We must tax these discounts. And then naturally, that had been overlooked for 10, 20 or 30 years, and the employees of these car factories and so had been used to it. And so they feared nearly a revolution in the areas where car factories were when they now began to tax it. And so they tried to make the transition as smooth as possible and thought about granting a free allowance for such discounts which you get from your employer to buy the employer's goods and services. And that is the reason behind Section 8.3. First, they say a certain amount of discount is something which everybody who can cleverly negotiate can obtain, especially if you belong to a big uniform group of buyers like employees. For example, if they acted as a group, they could easily negotiate a certain discount, and so 4% discount were regarded as tax-free because that could be justified with the market power of the group of employees if they acted as a group. Then an additional amount of the remaining discount, a certain amount was declared tax-free per year. At the moment, that's 1,080 euro. Originally, it was 2,000 marks. And only the remaining amount is then taxable. That is a nice opportunity to give people a nice complicated calculation. So, for example, if you get a discount of 20% from your boss and you buy goods for 2,000 euro with a discount of 400, then the 400 is a part of your taxable income. Now, 4% discount is ignored, so only 16% discount are taxable, so 320 in the case. Up to 1088, 1088 tax-free. So at the moment, it's not regarded as taxable income, but your employer has to keep lists of all the things which you bought with a discount and has to prove the amount of discounts which you got over the year. And from the moment onwards, when the limit of 1088, 1080 is surpassed, every additional discount which is taxable will be subjected to your income tax. It has to be communicated to your fiscal office. So if you buy a car for 20,000 euro with a discount of 30%, that would be 6,000 euro taxable income. Now 4% discount would be ignored. That would be 400 euro. 800 euro, 4%. Yeah. That would be regarded as a discount which every clever person could negotiate with a certain market force or negotiating power or ability. so that can be ignored and is officially declared as tax-free under K3, and only 26% discount are taken into account. Here 5.2 up to 1080 are tax-free, so the 4,120 euro which remain are taxable. I hope that makes the principle clear. And I want to remind you again about the difference between a free allowance, usually expressed as something is tax-free as far as the amount does not exceed this limit. That was the idea. You can march from 0 to that certain amount here, 1080. And that is always tax-free. And only the next euro and the next and the next. So what comes beyond the limit becomes taxable. And a threshold where something is free if a certain limit is not exceeded. And if is only a yes or no for all of it. So that was the case with the 44 euro or from next year onwards 50 euro, which you can get as goods or services from your employer tax-free per month for simplification reasons. If it's 51, you're lost. Yeah, good. Now the next topic we have to speak about is deductible expense, the definition of deductive expense. And I think, ladies and gentlemen, at the moment this part of chapter 4 is already so long that it should be time for a break, and that we should reserve that part of chapter 4 for another video. Thank you very much, and I would like to see you again soon, and I hope you could enjoy this, or can enjoy that it's over, or do whatever you like. But don't forget, when we just talk about like, don't forget to press a like button everywhere you can, to share that video with everybody whom you don't like, and naturally to remember all the stuff I told you. Thank you very much.